The question of whether the Federal Reserve System will collapse and the dollar will lose significant value by 2026 requires examining the intricate web of economic policies, geopolitical shifts, and structural vulnerabilities that define the current global financial order. And while predictions of imminent collapse have circulated for decades, recent developments suggest we may be approaching a critical inflection point, where the mechanisms that have sustained dollar dominance are showing unprecedented strain. To understand why some analysts believe the dollar faces a severe devaluation crisis within the next few years, we need to trace the architecture of the Federal Reserve's power, the historical precedents for currency collapse, and the specific catalysts that could trigger a rapid loss of confidence in what has been the world's reserve currency since the Bretton Woods Agreement established dollar hegemony in the aftermath of World War II. The Federal Reserve operates as the central banking system of the United States, wielding extraordinary power to set interest rates, control the money supply, and serve as lender of last resort to the banking system. Yet this institution that seems so permanent and unassailable is actually a relatively recent creation dating back only to 1913, and throughout its existence it has navigated multiple crises that threatened its credibility, from the Great Depression, where its policy mistakes deepened economic catastrophe, to the stagflation of the 1970s, when inflation spiraled out of control while economic growth stagnated. What makes the current situation potentially more dangerous than these historical episodes is the sheer scale of monetary expansion undertaken since the 2008 financial crisis, when the Fed's balance sheet stood at roughly $900 billion, but has since exploded to over $8 trillion through successive waves of quantitative easing, essentially creating money from nothing to purchase government bonds and mortgage-backed securities in an unprecedented experiment that has no clear exit strategy. This massive expansion of the money supply would traditionally be expected to produce severe inflation, yet for years this inflation remained mysteriously absent from consumer prices, leading many economists to conclude that the old rules no longer applied and that central banks had discovered a magic formula for unlimited money creation without consequences. But this complacency may prove to be one of the most dangerous delusions in economic history. The mechanics of how the Federal Reserve creates money reveal why the system contains inherent instability, because unlike a government that must tax citizens or borrow from investors to fund spending, the Fed simply creates deposits electronically and uses them to purchase assets, expanding the monetary base without any corresponding increase in real economic output or productive capacity. When the Fed buys $1 trillion of Treasury bonds, it credits the accounts of banks with reserves that didn't previously exist, and these reserves can then be multiplied through the fractional reserve banking system, where banks are required to hold only a small percentage of deposits as reserves, and can lend out the rest, creating new deposits in the process that further expand the money supply. This system works as long as confidence remains intact, and people believe that the dollars they hold will retain purchasing power. But once that confidence erodes, the mathematical reality of too many dollars chasing too few goods becomes impossible to ignore, and the currency enters what economists call a flight to real assets, where people desperately try to exchange paper money for anything tangible before their purchasing power evaporates entirely. Several specific developments suggest we may be approaching this tipping point where confidence breaks down and the dollar loses its privileged status as the global reserve currency, starting with the explosive growth of government debt that now exceeds $35 trillion and continues rising by over $2 trillion annually, even during periods of supposed economic expansion. This debt trajectory is unsustainable by any mathematical measure because the interest payments alone now consume nearly $1 trillion per year. And as interest rates have risen from near zero to over 5%, the cost of servicing this debt has become one of the largest line items in the federal budget, crowding out spending on infrastructure, defense, and social programs, while creating a doom loop where the government must borrow even more just to pay interest on existing debt. The only way the government can continue funding itself at these levels is if the Federal Reserve keeps interest rates artificially low or resumes purchasing Treasury bonds directly, but both options carry severe risks because low rates fuel asset bubbles and misallocation of capital throughout the economy, while direct monetization of government debt destroys any pretense that the dollar is backed by anything more than political promises. The international dimension of dollar dominance adds another layer of vulnerability because the United States has enjoyed what former French finance minister Valéry Giscard d'Estaing called an exorbitant privilege: the ability to print the world's reserve currency and use it to purchase real goods and services from other countries who must earn dollars through exports and hold them as foreign exchange reserves. This arrangement has allowed the United States to run massive trade deficits for decades, importing far more than it exports and accumulating foreign debt that would bankrupt any other nation, yet this privilege depends entirely on other countries continuing to accept and hold dollars in their central bank reserves. And there are growing signs that this willingness is evaporating as nations pursue de-dollarization strategies to reduce their vulnerability to American financial power. China and Russia have been leading this effort, signing agreements to conduct bilateral trade in their own currencies rather than using the dollar as an intermediary, and even traditional American allies in the Middle East have begun exploring alternatives to the petrodollar system, where oil has historically been priced and traded exclusively in dollars, giving the United States automatic demand for its currency from every country that needs to purchase energy on global markets. The BRICS nations, which now include Brazil, Russia, India, China, and South Africa, along with recently added members like Saudi Arabia, the United Arab Emirates, Iran, Egypt, and Ethiopia, represent a formidable bloc that encompasses roughly 45% of the global population and a growing share of economic output, and these countries have explicitly stated their intention to create alternative payment systems and potentially launch a new currency that could challenge dollar hegemony. While many Western economists dismiss these efforts as unrealistic, given the entrenched infrastructure supporting dollar transactions and the lack of deep, liquid capital markets in alternative currencies, this skepticism may underestimate how quickly change can occur once a tipping point is reached, because currency regimes that seemed permanent have historically collapsed with surprising speed when confidence evaporates, as happened with the British pound sterling, which dominated global trade for centuries before losing its reserve status in a matter of decades following World War II. Domestic economic conditions within the United States add further stress to the system because the productive capacity of the American economy has been hollowed out by decades of offshoring manufacturing to China and other low-wage countries, leaving the United States increasingly dependent on imports for everything from consumer electronics to pharmaceuticals to the rare earth elements essential for modern technology. This deindustrialization means that even as the Fed creates trillions of new dollars, there is less domestic production to absorb this monetary expansion, making it more likely that the money flows into asset price inflation in stocks and real estate rather than productive investment in factories and infrastructure, creating a bifurcated economy where asset owners become fabulously wealthy while workers struggle with stagnant wages and rising costs for housing, healthcare, and education. The wealth inequality this produces is not just a moral concern but a systemic risk, because an economy where most people cannot afford basic necessities, while a tiny elite accumulates unprecedented fortunes, is inherently unstable and prone to either political upheaval or economic collapse, when debt-fueled consumption can no longer be sustained. The banking system itself shows cracks that recall previous financial crises, because regional banks across the United States are sitting on massive unrealized losses in their bond portfolios, accumulated during years when they purchased long-term treasury securities at low interest rates that have since risen, reducing the market value of these bonds even though banks can avoid recognizing the losses by holding them to maturity under accounting rules. This situation came to public attention with the spectacular failure of Silicon Valley Bank in early 2023, which suffered a classic bank run when depositors realized the bank's assets were worth far less than its liabilities. But SVB was not an isolated case, and analysts estimate that hundreds of billions of dollars in unrealized losses lurk on bank balance sheets throughout the system, creating vulnerability to any shock that might trigger deposit withdrawals or force banks to sell securities at a loss. The Federal Reserve responded to this crisis by creating new lending facilities to provide banks with cash without forcing asset sales. But this intervention only postponed the reckoning and created moral hazard by signaling that banks would be bailed out regardless of their risk management, encouraging even more reckless behavior. Inflation dynamics have shifted in ways that suggest the monetary expansion of recent years is finally feeding through to consumer prices. Because after years of subdued inflation that allowed economists to dismiss concerns about money printing, prices began surging in 2021 and peaked at over 9% annual inflation in 2022, the highest rate in 4 decades. The Federal Reserve initially characterized this inflation as transitory, a temporary disruption caused by supply chain bottlenecks and pandemic-related distortions that would resolve themselves without policy intervention. But this assessment proved disastrously wrong, forcing the Fed to pivot to aggressive interest rate increases that brought rates from near zero to over 5% in the fastest tightening cycle in modern history. While headline inflation has since moderated from its peak, the damage to purchasing power has been severe, with the prices of food, energy, and housing rising far more than official statistics suggest. And crucially, inflation expectations have become unanchored, meaning people no longer assume prices will remain stable, but instead anticipate ongoing increases, creating a self-fulfilling dynamic where workers demand higher wages to compensate for expected inflation. Businesses raise prices to cover higher labor costs, and the spiral continues. The geopolitical dimension cannot be separated from economic factors because the dollar's reserve status has always been enforced not just by economic size, but by American military power and the alliance system that emerged from World War II. Yet this geopolitical order is fraying as American influence declines relative to rising powers, and the costs of maintaining global military presence become increasingly burdensome for a country with crumbling domestic infrastructure and social cohesion. The wars in Iraq and Afghanistan demonstrated the limits of American military power, consuming trillions of dollars while failing to achieve strategic objectives, and current tensions with Russia over Ukraine and with China over Taiwan threaten to escalate into conflicts that could shatter the remaining pillars of dollar dominance. If the United States were to lose a major military confrontation or even appear vulnerable to defeat, the psychological shift in how other nations view American power could trigger rapid de-dollarization as countries rush to reduce exposure to a currency backed by a declining hegemon. Central bank digital currencies represent another potential catalyst for dollar displacement, because China has already launched a digital yuan that could eventually compete with dollar-based payment systems. And if the convenience and efficiency of digital currencies leads to widespread adoption, the network effects that currently favor the dollar could shift remarkably quickly to alternative systems. The European Union is developing a digital euro, and even the Federal Reserve is researching a digital dollar, but the United States faces a dilemma where implementing a central bank digital currency could actually undermine the existing banking system by allowing people to hold deposits directly with the Fed rather than with commercial banks, potentially triggering massive deposit flight during any crisis. These technical innovations in money and payment systems may seem abstract, but they could fundamentally alter the landscape of global currency competition by making it easier to switch between different monetary systems without the friction and transaction costs that currently lock countries into dollar-based infrastructure. The Federal Reserve's policy options are increasingly constrained because the traditional tools of monetary policy no longer work as textbooks suggest, since raising interest rates to fight inflation risks triggering recession and financial crisis, while lowering rates or resuming quantitative easing would accelerate inflation and destroy credibility. This policy bind is sometimes called the Fed's impossible trilemma, where it must choose between controlling inflation, supporting economic growth, and maintaining financial stability, but cannot achieve all three simultaneously given the structural imbalances in the system. Any choice involves painful trade-offs that could accelerate the timeline toward crisis, because if the Fed prioritizes inflation fighting with sustained high rates, the weight of government debt service and corporate refinancing needs could crush economic activity and trigger defaults throughout the financial system. But if the Fed pivots back to easy money to support growth and bail out failing institutions, the resulting currency debasement could trigger the very collapse of confidence that turns gradual dollar decline into catastrophic failure. Historical parallels offer both warning and context because no fiat currency in history has survived indefinitely, and the average lifespan of reserve currencies throughout history has been roughly 80 to 110 years, which suggests the dollar's reign since Bretton Woods may be approaching its natural end. The Roman denarius was gradually debased over centuries as emperors reduced its silver content to fund military campaigns and state expenditures, eventually becoming nearly worthless and contributing to the empire's economic collapse, while more recent examples like the Weimar Republic show how quickly hyperinflation can destroy a currency when governments resort to printing money to cover obligations. The Weimar case is instructive because Germany was an advanced industrial economy with sophisticated institutions, yet inflation spiraled from manageable levels to absolute catastrophe in just a few years, once the process gained momentum, with prices doubling every few days at the peak and people literally needing wheelbarrows of cash to buy basic necessities, demonstrating that currency collapse is not limited to backward economies, but can strike any nation that loses fiscal and monetary discipline. The specific trigger for dollar crisis could come from any number of directions, perhaps a sovereign debt default by a major economy that sparks contagion through interconnected financial markets, or a geopolitical shock like war or energy crisis that disrupts trade flows and exposes the fragility of global supply chains, or simply a psychological tipping point where market participants collectively decide the emperor has no clothes and begin dumping dollar-denominated assets in favor of alternatives. Financial markets have a tendency toward herd behavior where everyone rushes for the exits simultaneously once fear takes hold, and the very speed of modern electronic trading means that a crisis can unfold in hours rather than the days or weeks that previous generations had to respond to market dislocations. The flash crash of 2010, where stock markets temporarily lost nearly $1 trillion of value in minutes before recovering, demonstrated how algorithmic trading and interconnected systems can amplify small disruptions into systemic shocks. By 2026, several specific deadlines and cyclical factors converge in ways that could catalyze crisis, because the federal debt ceiling will need to be raised again, forcing political confrontation over spending that could result in government shutdown or even default if partisan gridlock prevents resolution, while simultaneously a large volume of corporate debt issued during the low-rate era will need refinancing at much higher interest rates, potentially causing a wave of bankruptcies among over-leveraged firms. The commercial real estate sector faces particular stress because office buildings have lost value dramatically due to remote work trends, and regional banks holding these mortgages could face mounting losses that trigger another banking crisis. Presidential election cycles create additional uncertainty because drastic policy shifts become possible, and global investors may reduce dollar exposure ahead of contested elections that could produce political instability. These factors individually might be manageable, but their simultaneous occurrence creates the kind of perfect storm that overwhelms policy responses and causes cascading failures across multiple sectors. The alternative scenarios to outright collapse should also be considered, because it is possible that the Federal Reserve could navigate these challenges through some combination of inflation, financial repression, and gradual adjustment that reduces dollar purchasing power significantly without triggering hyperinflationary collapse. This managed decline might involve allowing inflation to run at 5 to 10% for years while keeping interest rates below inflation, effectively taxing savers and bondholders to erode the real value of government debt, a process that has historical precedent in how the United States reduced its debt burden after World War II. Financial repression could include capital controls that limit citizens' ability to move wealth out of dollar-denominated assets, or regulations forcing pension funds and insurance companies to hold treasury bonds regardless of returns, creating a captive market for government debt. This scenario is less dramatic than sudden collapse, but arguably more insidious because it slowly impoverishes the middle class, while being difficult to resist through any individual action. International developments will largely determine whether alternatives to the dollar system can actually emerge, because creating a new reserve currency or multipolar currency system requires overcoming enormous coordination problems and building the institutional infrastructure to support international trade and finance. China faces its own severe economic challenges, including a real estate crisis that dwarfs the 2008 American housing bubble, local government debt that may be unpayable, and demographic decline that will shrink its workforce and consumer base in coming decades, raising questions about whether the yuan could serve as a stable reserve currency even if countries wanted to use it. The euro has failed to displace the dollar despite the economic size of the European Union because the eurozone lacks political unity and a common fiscal policy, making it vulnerable to debt crises in member states that can threaten the entire currency union. These limitations of alternatives might actually prolong dollar dominance, even as its fundamentals deteriorate, because market participants may conclude there is no better option despite recognizing the dollar's flaws. The societal implications of dollar collapse or severe devaluation would be profound, because the United States has structured its entire social model around cheap imports and debt-fueled consumption, meaning that a dramatic loss of purchasing power would force painful adjustment in living standards that Americans have come to take for granted. Imported goods that currently fill stores would become expensive luxuries. Domestic production would need to be rebuilt, but this takes years or decades, and the social safety net, including Social Security and Medicare, depends on governments' ability to borrow and print money, which becomes impossible once currency credibility is destroyed. The political consequences could be equally severe, because economic crisis on this scale typically generates populist movements and authoritarian leaders who promise simple solutions to complex problems. And the polarization already evident in American politics could intensify into genuine threat to democratic institutions if large portions of the population face immiseration and blame the existing system for their suffering. What makes the 2026 timeframe plausible rather than just another failed prediction is the convergence of multiple indicators showing stress in the system simultaneously rather than isolated problems that can be addressed individually. Because the debt trajectory is unsustainable, the geopolitical environment is deteriorating, the banking system is fragile, inflation has proven difficult to control without causing recession, and de-dollarization efforts are accelerating among major economic powers. These are not theoretical risks, but observable trends that compound each other in ways that could overwhelm policy responses. And while the exact date of crisis cannot be predicted with precision, the underlying dynamics suggest that the window for gradual adjustment is closing and the probability of disruptive change increases substantially over the next few years. The Federal Reserve and US government may attempt various interventions to postpone reckoning, but each intervention creates new distortions and risks that make the eventual adjustment more severe when it finally arrives. Understanding these dynamics is crucial not for making definitive predictions about precise timing, but for recognizing the structural vulnerabilities in the current system and preparing for a range of possible outcomes that include scenarios far more disruptive than mainstream discourse typically acknowledges, because the combination of monetary excess, fiscal irresponsibility, geopolitical decline, and erosion of productive capacity creates conditions where dramatic change becomes not just possible but perhaps inevitable.